Why do some investors thrive while most fail? The truth lies not in luck or timing, but in timeless principles of patience, risk, and freedom. Today we decode the habits of the most successful investors and how to apply them in life. Every successful investor has one advantage you can't see on a chart: discipline. They treat time as an ally, not an enemy, and they never confuse volatility with loss. So what separates a successful investor from the crowd, and how can those same habits guide your own life portfolio? Stock market success isn't about gambling on the next hot stock. It's about building a system that compounds. Like portfolios, our lives need diversification, patience, and the courage to hold through downturns. The Stoics remind us, the market will fluctuate, but our principles should not. Today, we decode the hidden portfolio of every successful investor and why adopting it might be the best trade of your life. Why successful investors think in probabilities, not certainties, and how this prevents panic both in markets and in life. Successful investors don't think in certainties, they think in probabilities. The Stoics knew the same truth centuries ago. The future is uncertain, but our preparation is always in our control. This mindset prevents panic when markets swing wildly because volatility is expected, not feared. Warren Buffett has said he never cares about the market's daily mood, only the long-term value of the businesses he owns. That's the essence of an investor's mindset. Focus on process, not prediction. Epictetus would call it focusing on what is up to us, not tomorrow's price, but today's discipline. In the stock market, those who chase certainty are gamblers. Those who embrace uncertainty with preparation are investors. And in life, those who demand guarantees are often disappointed, while those who prepare for probabilities thrive. Successful investors don't predict, they prepare. The real edge is emotional, resisting fear in crashes and resisting greed in bubbles. Marcus Aurelius reminded himself daily that external events are beyond his control, but his reaction is always his investment. This is why the investor's mindset is not only profitable in markets, but also in careers, relationships, and even health. Wealth in the stock market is not built by timing, but by time itself. Patience is the dividend that compounds invisibly until it suddenly becomes undeniable. The investor who reinvests dividends is like the person who reinvests good habits. Both create exponential growth. Benjamin Franklin understood this. He left money in a trust to compound for centuries, creating fortunes long after his death. Most people overestimate what they can achieve in a year, but underestimate what they can achieve in a decade of compounding. Seneca warned that life is wasted not by its shortness, but by the squandering of it, just as investors squander wealth by interrupting compounding. Impatience is the investor's greatest expense. Patience is their greatest asset. Every successful investor knows the real returns come not from sudden leaps, but from steady accumulation. This mirrors life itself. Small daily disciplines, like small deposits, compound into freedom over time. Ask any successful investor and they'll tell you returns matter, but survival matters more. The Stoics taught the same principle: prepare for storms before the clouds appear. Risk management is the art of staying in the game long enough to benefit from compounding. Ray Dalio calls it the all-weather portfolio, structured not for sunny days, but to withstand economic winters. Hedging isn't about predicting disaster, it's about respecting uncertainty. Marcus Aurelius accepted that adversity is not a surprise but a certainty. What matters is whether we're prepared. This is why successful investors hold cash, diversify, and resist over-leverage. And in life, resilience is our hedge. Emotional savings, strong habits, and friendships that protect us when markets, financial or personal, crash. You cannot control the market cycle, but you can control whether you are forced to sell at the bottom. Likewise, you cannot control life's downturns, but you can choose whether to be broken by them or merely tested. The investor without risk management eventually blows up. The person without resilience eventually burns out. The stock market is not the only market worth studying. Society itself is a market, full of cycles, bubbles, and crashes. Just as investors watch financial indicators, we should watch social indicators: debt levels, cultural trends, political incentives. Every bubble has the same pattern, whether in housing, technology, or even social media hype: irrational exuberance, inflated valuations, and eventual collapse. The Stoics warned against being swept by the crowd because the crowd is often irrational, chasing what Seneca called borrowed desires. Look at history: the tulip mania of the 1600s, the dot-com bubble of the 2000s, and the meme stock frenzy of 2021. All different assets, same psychology. And governments often play their role too, inflating currencies, subsidizing risky behavior, or bailing out those who refuse to hedge. Inflation is the perfect example, a hidden tax that silently drains portfolios while rewarding those who own real assets. Inflation is a tax you pay for standing still. Marcus Aurelius wrote that external events are like winds. You cannot stop them, but you can adjust your sails. The same applies to policy changes and economic shifts. A successful investor reads these winds, not with panic, but with strategy. Consider how investors who understood globalization in the 1990s captured growth, while those who ignored it missed entire decades of wealth creation. The same is true today with AI, green energy, and demographic shifts. The trends are visible, but most ignore them until it's too late. The wise approach is not to predict the exact outcome, but to position yourself so that whatever the outcome, you are not destroyed. In markets, this is diversification. In society, this is adaptability. The Stoic investor does not complain about policies, taxes, or crises. They adapt as a rational strategist in an irrational market. Just as a portfolio must be rebalanced against economic tides, our mindset must be rebalanced against cultural tides. To follow the crowd blindly is to risk being caught in a crash. To observe calmly and act deliberately is to position for opportunity. Ask yourself, why do successful investors invest at all? Is it just for more zeros on a balance sheet? The Stoics would say no. because wealth without freedom is simply another form of slavery. The true ROI of investing is not measured in dollars, but in the freedom of how you spend your days. History proves this. Wealthy merchants in ancient Rome used their fortunes not for luxury alone, but to buy independence from politics and control over their time. Today, successful investors echo the same pattern. They don't chase riches just to consume more, but to buy peace of mind, security, and choice. Seneca once wrote, "It is not the man who has little, but the man who craves more, that is poor." Investors understand this deeply. The game isn't to own everything, but to need less. The ultimate ROI isn't money, it's freedom. Think of compounding not as just financial growth, but as freedom growth. Each disciplined decision buys you time tomorrow. Marcus Aurelius ruled the largest empire on earth, yet his journals reveal that his true wealth came not from power, but from mastering his own desires. The modern investor faces the same choice. Will you chase endless gains, or will you define the point where enough is enough? Stoicism teaches that freedom begins when our wants shrink below our means. Investing is simply a vehicle to accelerate that truth. Financial wealth without control of time is like dividends you can never withdraw, numbers that never translate to freedom. But when your portfolio buys you the ability to say no to a job, to noise, to unhealthy relationships, you have achieved the investor's truest return. The best investors are not the richest, but the freest. The habits of successful investors aren't secret formulas, they are timeless disciplines. Focus on what you can control, accept volatility, treat every setback as a deposit into your resilience fund. Rebalancing is not just for portfolios, it's for your life. When you adjust your priorities, values, and actions, you become anti-fragile, able not just to survive downturns, but to grow stronger through them. Think of it this way: every financial correction has created fortunes for those who were prepared. Every personal correction can create freedom for those who are disciplined. The Stoic investor's advantage is calm focus in a distracted world. Rebalancing isn't just for portfolios, it's for your life. If you've stayed with me until now, you already think differently from the average market participant, and that mindset is your first compound return. If you want to keep compounding wisdom, click to watch our next video on The Stoic Investor's Guide to Surviving a Market Crash. And if this message resonated, subscribe now, because every week we rebalance not just portfolios but perspectives. Stay rational, stay resilient, and remember, the ultimate ROI is freedom.